Good morning, ladies and gentlemen. Thank you very much for coming along today. As Victor mentioned, my name is Guy Anderson and I am from JP Morgan, where I manage the Mercantile Investment Trust, which is one of our most long-established investment trusts. Mercantile was incorporated in December of 1884. So in fact, we celebrated our 140th anniversary a couple of months ago by opening the London Stock Exchange. So it does have a long and reasonably exciting history. But I'm here to talk to you about what it is we're doing today and how we're thinking about the future. This investment trust, having been established such a long time ago, has had a number of incarnations, having initially been focused on investing in the emerging markets of the day, which back when this was incorporated meant the United States. But actually, over the years, the focus moved more towards the United Kingdom. And since 1994, we have been investing in UK-listed mid and small caps. And so I would like to spend a little bit of time now just explaining why we think UK mid and small caps specifically are an interesting market in which to invest. I'll then spend a few minutes discussing our portfolio strategy, so how we actually build the portfolio of companies which are going to drive that future growth. And then I'll talk about the current outlook and how the fund, or the trust rather, is positioned for the world as we see it. Now, in terms of the case for UK mid and small caps, I think ultimately the numbers give the best view of why we think this is an attractive market. And as we can see, since June of 1994, which was the point at which we formally adopted this focus on UK mid and small caps, markets across the globe have, of course, delivered some pretty phenomenal returns over that time. And the power of compounding, of course, makes the absolute numbers look really quite tremendous. But I'd focus your eye for a moment on the yellow line. This represents the returns delivered from the FTSE 250, which is the UK's mid-cap index. And that is a market that has returned approximately 10% per annum just over this 30-year time horizon. And that compares very favorably with, if you scan your eyes further down the axis, you can see, I can't quite make out the color, but I think it's a dark blue line, which shows the FTSE 100, so the large cap market in the UK, which has returned, from memory, I think it's 6.5% per annum. So quite a material delta between the mid cap index and the large cap index over that time period. And really, we believe that that is driven by the higher growth prospects of mid and small cap companies, and the fact that mid and small cap companies have historically grown at a higher rate than larger companies. Now, of course, I shouldn't just completely ignore the dark blue line in this chart, the light blue line in this chart, which shows the returns of the S&P over that period, which has returned nearly 12% per annum over that 30-year time horizon. And of course, that is that has been a bit of a vortex for capital over the last few years. But one of the benefits, I would hope, of running Mercantile is the fact that we're actively managing this strategy. And so, of course, we have the potential to do better than the underlying market in which we're investing. And we can see on the slide that we show here, we have overlaid on that chart the performance of Mercantile over this time period, which hasn't quite kept up with the S&P, but we have delivered over the last 30 plus years an 11.5% compound annual return. So I think this is a really exciting market in which to invest, and I'll unpick that a little bit more as we go through and talk about a few specific companies in which we're investing, which really are the driving force behind the returns, of course. Now, in terms of the portfolio strategy, Mercantile is looking to deliver long-term capital growth from a portfolio of UK-listed mid and small cap companies. So we will typically invest in companies that are below the FTSE 100, but we will retain holdings in those companies as they move up through the market cap spectrum. And indeed, where we sit today, a little bit under 20% of the portfolio is invested in FTSE 100 names those are names that we bought when they were either mid caps or in some cases small caps, but their growth has propelled them up into being large cap companies. So a good example of that would be Games Workshop. So they are, for anyone who's not familiar with Games Workshop, they are behind the Warhammer hobby. They design, manufacture, and sell Warhammer figurines. These are tabletop figurines which are set in a number of different potential universes, the largest of which is called Warhammer 40K, so that is set in the year 40,000, where you'll be pleased to know in this theoretical universe there is only total war, and people will buy these figurines, they will build them, they will paint them, and then they will play the tabletop games. So it is a very involved hobby, and it is something that many people will pick up as children, but they will retain through their life. And the extremely dedicated focus of this business on building on their intellectual property, on expanding the hobby and making it constantly better and better for their users, has delivered incredibly powerful growth and returns. And so that is a company that we bought as a small cap, which is now, as of 4 months ago, a member of the FTSE 100. And we are still significant shareholders in that business and expect them to go from strength to strength. And anyone who is a member of Amazon Prime will hopefully be excited to know that in a couple of years, there will in fact be a Warhammer program, which will likely feature Henry Cavill, which may or may not be important for some people. But so an exciting future. So we will hold companies as they move through that really exciting growth phase. Now, how do we pick companies for the portfolio? We pick companies based very much on bottom-up stock selection. So it is about analyzing the prospects of a specific company and assessing the share of that company to determine whether or not we think that has really attractive potential for the future. And a lot of that is underwritten by the fundamental analysis that is performed from within my team. So I have the pleasure of leading our UK mid and small cap team at JP Morgan. But of course, we are supported by the very deep breadth of analysis that we get from our wide-ranging teams in terms of across a number of different industry sectors. My team, in aggregate, do between 400 and 500 management meetings a year. So we meet between 400 and 500, either different companies or repeat meetings with the same companies, typically meeting the CEO or the CFO of that business in order to really quiz them and interrogate them on the prospects for their business in order to understand what exactly their growth prospects are and how the company is going to deliver that growth. So that is a quick snapshot of how we manage the strategy. In terms of a couple of other credentials of the investment trust, it is a reasonably significant portfolio. So the portfolio size is a little bit north of £2 billion today, which is important for end investors because it means we clearly have critical mass, but also there's good underlying liquidity of the Mercantile shares. So it's very easy to buy and sell shares in Mercantile. And then, of course, with the benefits of scale come relatively low ongoing charges at below 0.5%. So those characteristics may or may not be interesting, but what really matters is whether or not we're going to deliver decent returns for you, the end investors. And there's a lot of bars on the right-hand side of this chart because of the number of different metrics and ways in which investment trusts perform their accounting. But what you can see is over the previous 1, 3, 5, and 10 years, you can see the returns that we have delivered on an annualized basis. What I would really focus on, though, is the cumulative impact of those returns. So we show on this slide, hopefully I'm on the right slide, we show the returns since I came on board. So I joined the team in summer of 2012, and since that time, you can see that we have delivered a return for shareholders of 10.5%, which is roughly 3% per annum ahead of our underlying benchmark, which is the FTSE All Share excluding the FTSE 100. So the ability to compound those returns obviously magnifies over time and leads to I can't quite see the number, but I think it's about a 250% return over that time period. Now, alongside that focus very much on long-term capital growth, we have an additional objective that the board sets, which is to grow the dividend at least in line with inflation over the long term. And it is pleasing to note that over the last 30 plus years, since we adopted that objective, the dividend has grown at a compound annual growth rate of around 8.5%. And the dividend has never been cut in that time period. Now, of course, no one can ever offer any promises in this world, but I think it's interesting to note that through the GFC and through the pandemic, the dividend that Mercantile paid out was never cut. And indeed, through the pandemic, we continued to increase the dividend that was paid to investors. And that is facilitated, of course, by the investment trust structure, a structure in which we can choose to retain earnings in certain years and then pay it out in other years, and thus smooth the income profile for you, the end investors. And the final dividend for the financial year that just ended in January of this year was announced yesterday. So the dividend for last year came in at 7.9p, which for context is an approximate 3.5% dividend yield. So this is a byproduct of the investment process, but I think is an important component of the returns that you, the end investors, can seek to achieve. Now, what is it that we actually look for in our investments, in companies that we're looking at? We ask three really critical questions. So first of all, is it a good business? Is this a business that has good economics, i.e. has good profits, converts those profits into cash, and they can reinvest that cash to drive future growth? That is critical for the long-term compounding of earnings and growth. Second of all, is the outlook improving? And here, I'm not talking about, do we think it's going to have a good quarter next quarter versus the last quarter? We're really thinking about, is this a business that is going to generate better financial returns over the next 3, 4, 5 years than the market currently expects? It is that variation in perception, the gap between the market's current expectations and the eventual outcome, that is critical to our success. And then thirdly, are we paying a sensible price for this share? It is one thing to think about a great business that has, that it has great quality credentials and will grow, but if we're paying the wrong price, we won't generate an attractive return. So we think very carefully about the valuation, focusing on a number of different metrics. Now, portfolio managers will rarely tell you that they're buying bad businesses with a deteriorating outlook that are overpriced. So it's occasionally good to check, are we actually doing what we say we're doing? And some of these characteristics hopefully demonstrate that. So in terms of the quality characteristics, the return on invested capital on a look-through basis of our portfolio is around 15% versus around 10% for the broader market. So what that means is for every £100 that a portfolio company invests to drive growth, on aggregate, that will return £15 of profits. So that's quite material. Is the outlook promising? I think everyone will be aware that there are some certain macroeconomic challenges in the world at the moment. And what we're generally seeing is expectations are coming down. What has been reassuring is that in our portfolio, companies have been continuing to meet our expectations, and so we're not seeing that growth degrade. And then thirdly, are we paying the right price? Well, on a free cash flow yield basis, the portfolio is just over 8% versus around, I think it says around 7% for the benchmark. So what that means is for every £100 invested, or for every £100 of valuation in the portfolio, it's generating, or over the last 12 months, generated around £8 of genuine free cash that is available to us as investors or to the company to either return to investors or to drive future growth. So to bring that to life a little bit, I've got a couple of examples which I'll spin through. We have an investment in Cranswick, which I'm aware that has actually already been mentioned in one of the earlier sessions, so I'll make it relatively brief. But Cranswick is a pork and poultry processing business. So they will produce a lot of the meat products that anyone could buy from one of the supermarkets. That is a tough industry. You have big customers, you have volatile input prices and output prices. So it sounds like a pretty awful setup. But the great thing about this business is the differentiation they have versus their competitors, which has been built upon years and years of product innovation and investment in capital, which will drive increased automation from a very manual process to a more automated process, and those investments in capital, which will expand their capacity and thus drive their ability to take market share. And conscious that some people will have heard this story before, but that is why over the last 10 years, and indeed over the last 30 years, they've been able to compound their growth at a double-digit rate, so continuing to take market share. This is a business I think we are particularly excited about for the years ahead. They had a capital markets day a week or so ago where they announced that they're going to increase their investments in new capacity and in automation, etc., by 50%. So they're going to move from investing £100 million a year into the UK to investing £150 million a year. And that is going to drive a substantial pickup in their growth in the years ahead, which we think is pretty exciting. Now that's a more domestic, consumer-facing business. Another example in the portfolio is a holding that we have in a company called Rotork. Now this is an industrial business. They manufacture and sell actuators. Actuators are the devices that control valves. So they're not taps, but if you think of a tap, it's a reasonable starting point. The device that control valves. And these are used in pretty much every single flow control industry that you can conceive of. So in terms of end markets, they're used in oil and gas, they're used in the water industry, the power industry, chemical industry, food industry, every single process industry. And these are typically critical applications, but they are relatively small components that are put into these large processing industries. And that's really important because it means they have great pricing power, and the product credentials of Rotork are really important. So that means they generate very strong economics. So they have really good profitability and they can invest their cash to drive further growth. Examples of markets in which they're really focused at the moment include the water industry. Now, of course, everyone will be aware that a lot of the water infrastructure across the globe is aging and it needs renewal. And then there are areas in the globe where there's a huge focus on increasing freshwater capacity, so desalination plants. So for instance, in Saudi Arabia, I think they're investing £90 billion at the moment in desalination plants. That will contain hundreds, if not thousands, of actuators that come from a company like Rotork. In Chicago, in their water treatment plant in Chicago, they're still using incredibly old pneumatic actuators that are manually operated. Those will all be replaced by electric actuators that are automated, and they will all come from Rotork. So there's a great number of growth opportunities ahead for a business like that, which is why we're so excited and why it features in our top 10. Now, in terms of the outlook and how we're positioned, I think it's important to be realistic about the economic outlook, but at the same time, because we're focused so much on the stocks, I don't want to dwell on it too much. When we think about the outlook, economies don't necessarily drive the stock market, but they are, of course, important and related. And for our portfolio, mid and small caps in the UK, they are more domestically oriented than many large caps. So around between 50 and 60% of the revenue, typically on a look-through basis, will come from in the UK. Now, as we all know, inflation has been a problem in the UK for a number of years, not just in the UK, but a number of markets. But that has begun to normalize, as we see, back down sub 3%. Now, against that backdrop, the domestic consumer has actually been pretty resilient. And the chart on the left, it's a little bit of a noisy chart, but I would focus on the sort of yellowy orange bars. These show the change in real wages for the average consumer. So on average, are we getting pay increases that are higher than inflation? And what you can see is that has been the case for the last year and a half to 2 years. So actually, the average consumer is better off today, despite all the negative press and the negative narrative which the UK seems to feed off. The average consumer is better off today than a year and a half ago. But confidence, which you can see on the left-hand side if you focus on the dark blue lines, has taken a bit of a step back. Clearly, there are a number of factors at play, and there is a huge amount of uncertainty in the world at the moment. But we can see specifically in the UK that consumer confidence, which was recovering, and business confidence, which was also recovering, has taken a little bit of a knock over the last 6 months. I think time will tell as to whether or not that proves to be a blip or part of a sustained downturn. And so it is a balance. And so we have to think about that when we're investing in our companies so that we're not overexposed to those companies that are just dependent upon a positive economic environment. We focus instead on the specific company drivers so that our companies, which we think of as structurally strong companies, can deliver attractive returns even in a soggier economic landscape. Now, one of the headwinds to returns over the last few years has inevitably been the derating of the UK market. And I'm not going to dwell on this, but it is worth noting. Our part of the market used to trade on 15 times earnings. Today, it's actually on about 11 times earnings. So what that means is for every £100 you invest in the UK market, you used to generate, call it £6.5 of income. Not income in terms of dividend, but £6.5 of income for the companies in which you invested. Today, that would be closer to £9. That is quite a material change because that income that those companies can generate can again be returned to us as shareholders or invested to drive future growth. And in mid and small caps, the part of the market that I care about, that is also the case. So the chart here, again, we don't need to focus on all of it, but effectively the yellow and blue lines show the valuation multiple of the large cap market and the mid cap market, and the green smudge shows the premium or discount of the mid cap market to the large cap market. The punchline being that the mid cap market is currently trading at a cheaper valuation than the large cap market, which does happen at various points in time, 2008, 2016, 2020, but tends to be a rarity rather than the norm. Now, other people are seeing that valuation opportunity. M&A activity is always a phenomenon. There's a natural process where companies come to the market and eventually many of them leave and they may be taken over. In the UK, the percentage of our part of the market last year that was taken over was 11%, which is 5 percentage points above the long-term average. So other corporates are seeing that opportunity and buying companies from the UK. So that's the backdrop. And how do we position the portfolio against that? This is a relatively low velocity strategy. So on average, we turn over 20% of the portfolio per annum. So on average, we're holding investments for 5 years. And you saw, I think in the case of Rotork, we've held it for 8 years. I think Cranswick is 6 or 7 at the moment. But there are changes that we make. And this chart just highlights some of those changes. So the biggest area of change last year was in the financial subsector, where we made a couple of new investments. I won't dwell on them too much, but we made a new investment in Plus 500, who operate a trading platform where retail investors can buy and sell shares, often through CFDs. We invested in Integrafin. They operate an investment platform called Transact, which is focused on IFAs to help IFAs and their clients manage their finances better. And we invested in Pollen Street, which is an alternative asset manager that focuses on private equity and private credit, which following its merger with Honeycomb Investment Trust has set out really ambitious growth objectives for the years ahead. But it's not all about the long-term growth. We invested in one of the brick makers. In fact, we invested in 2 brick makers last year who have big market positions in the UK. Now, the brick manufacturing industry is intrinsically linked to house buildings and the level of house building activity. So Ibstock and Forterra being the 2 names. Now, if the government succeed in increasing the amount of new house building that happens in the UK, they obviously have their target over the course of this parliament. If that happens, then house building has a great opportunity to recover from the absolute low point of the cycle towards better returns. And that will benefit a company such as Ibstock or indeed Forterra, and indeed Volution, which is on the chart here, who manufacture ventilation products, which also go into new houses and existing homes. Hopefully you can see from our top 10 positions, some very long-standing and familiar names for those of you that have heard me talk before, because there isn't a huge amount of change. We have invested in, as I mentioned, companies like Intermediate Capital and 3i. We have owned, in both of their cases, actually for around 12 years now. Bellway has been a long-term holding. That is a house builder that could well benefit if some of the Labour Party's ambitions come to light in terms of fixing some of the restrictions on the supply side in order to free up house building. But then new names do feature as well, Plus 500, which I talked about before. And these are companies that we think have a really attractive long-term growth opportunity ahead of them, even in that tougher macro environment. Now, portfolio managers are always going to stand up and talk a positive story, but it may be of interest to see what we're actually doing rather than what we say we're doing. And I think that is best demonstrated by our gearing. As an investment trust, we can gear. What you can see from this chart is that our gearing today is close to the highest it's ever been. So the portfolio today is 15% geared, which is enabled by our long-term low-cost debt. And that is a clear demonstration, I would think, that we are finding more companies in which we want to invest than those that we want to sell. And hopefully that is a positive message to finish on, because I think this is a really attractive part of the market in which to invest. But we will only deliver good returns in the future if we maintain this disciplined investment process. I think discipline when investing is really important. And our focus today is very much, as it always is, but it's very much on investing in strong businesses with very attractive valuations where we can see a compelling long-term return profile. So with that, I'd like to thank you all very much for your attention, and I hope you enjoy the rest of the day.